Hey guys, Mike Demick here from the CMBA's Technology in Mortgage Banking Committee. I'm really happy to present our third video in our series. This one's going to focus on the digital mortgage process. We're going to talk about online applications, documentation relief, and electronic closings. I'm going to do a really short intro because it's a really long video with a lot of really good content. So thank you, and I hope you enjoy it. Rachel, tell me about your online application system.
So we have an online application system that's tied into our loan origination system.
Part and parcel or a bolt-on?
No, it's part of the entire package. So we actually made a change to that online system about 18 months ago when we switched LOS providers. So we've done online loan applications in many various forms and applications since about 2007.
And comparatively, compare your newer solution to the older one in terms of features, and do you have services bundled in such as AUS, pricing, and other ancillary services?
Sure. So right now the online application system is really just the application. We're not pulling credit, running AUS, we're not offering products to the borrower or doing any of those things. The services are offered, and as of this moment, we haven't bundled them in yet.
Did you have them in your previous
system? Yes, and actually when we went live with our previous online application, at a time when it was still fairly new, especially for a bank to offer online applications, we had like the full suite. We took all of the information needed to make a full app. We ordered credit. We offered products, so the borrower would get the full idea of their picture right there. They could select a product and a rate, and it disclosed to them. So we turned off the disclosing on that system in 2015 with the implementation of TRID because of the enhanced disclosure concerns that went along with TRID. But it was a very different experience for the borrower, that system versus our new system.
I mean, in a vacuum, in a sandbox, offering all these services bundled into the application sounds, in theory, pretty cool.
It does.
I'm starting to think, though, that maybe there's some traps there if you start bundling up all those services.
I agree. And I think it's part of the larger landscape of the mortgage industry and all of the things that we hear, so much information about the digital mortgage process and the digital experience, and borrowers want a fully digital, fully online experience. And what we found is borrowers really want a blend. They want a mix of everything. I want to be able to engage you online. I want to be able to engage you in person, on the phone, via text, however it is that you're able to meet them. And it's still such a customized experience. I mean, if borrowers were able to go on and pick exactly the right product for themselves, give us exactly the information we need, where does that leave loan officers?
Right.
The loan officer is such an integral and key part of a successful mortgage process. So in our previous iteration of an online interaction, sometimes you lost a little bit of that personalization, allowing the borrower to go so far in the system, because then it would come into the bank as kind of a fully baked or seemingly fully baked application with a lot of information, which is great. But you lost a little bit of that kind of counseling aspect of it, where with the system that we have now, borrowers are able to kind of give us a narration of what they're looking to do. We do take a full application online. We do take a full 6-piece RESPA application that goes into the loan officer's pipeline. They can select a loan officer to work with, so they already kind of have that face and name of somebody who's going to be calling them. And they can give us a narration. We give them the opportunity to kind of tell us what's up. What are you trying to do? What are you looking for? And that really initiates the conversation. So a loan officer, or if they didn't select a loan officer, an assigned loan officer will contact them and start that conversation, start that ball rolling. So they get kind of the best of both worlds. They didn't have to come in and sit down with somebody to complete a mountain of application paperwork while that person input it into a system. They could self-service that piece of it, but they still have a dedicated mortgage professional able to counsel them through all the different aspects, especially for the home buyer and not refinancing.
Interesting, you touched on the fact that you allow for the 6-piece of information. Have you run into any TRID traps where you now have to take action? You've got to disclose within 3 days. And I know there's companies that have taken the opposite. They've only allowed, say, 5 and eliminated maybe estimated value or potentially the street address. What's the thought process around allowing the 6?
It's really about trying to be as compliant as possible and still first meeting the spirit of the TRID rule. But but having the service there for the borrower. So sure, we run into, the kind of tire kickers. I didn't realize I was actually completing an application, or those people that never get back to you, and you're sort of in that black hole of I've got all the pieces of information I have to disclose.
Sure.
So, and that's where having a true mortgage professional on the other end, not just somebody kind of doing data entry, comes into play to be able to look at it and say, this is what they said they were trying to do. This seems to be the product that meets their needs, disclosing based on that and letting them know we can make changes to this at any time.
Sure.
Being with a community bank, I think we have a little more flexibility in that process, not as far obviously as complying with TRID and all of our other disclosure rules, but being able to have that smaller suite of products and the flexibility to jump between products.
Sure.
Somebody might come in saying, hey, yep, I want a home equity loan and this is what I'm going to do. The loan officer discloses it. When they finally get in touch with the borrower, say 3 days after disclosure, and they say, no, maybe a full refinance is better, we can just change gears.
That's awesome. Because I'm envisioning a worst case scenario where if you have a product availability online, and you look for the product with the lowest rate, which might be a 3-1 ARM.
Correct.
They go through this entire process and get towards the end and say, wait a second, in 3 years my rate goes up? I don't get it.
Yeah, and we ran into that with our old system that, and it's human nature. I can't fault any loan officer for it, but the loan would come into our system, like I said, almost fully baked. I've got a product, I've got a credit report, I've got DU, I've got disclosures.
Sure.
So I'm just kind of going to collect my supporting documentation and send it on. And sure, and I was processing at the time with the bank, and I would have those phone calls. Somebody gets, hopefully not as far as closing, but it did happen a couple of times, saying, well, why do I have this PMI? Why do I have an adjustable rate? I don't want that. Why do I have an FHA loan? Why do I have?
Right.
Because as informed as borrowers are and have become over the last decade, they're still not mortgage professionals.
Right.
So there's so many intricacies that they don't understand. They should have at least the opportunity to sit with a loan officer, have a conversation on the phone, in person, via text, via email, however they want to be approached, to give that information and to really have that counseling moment of ultimately the product decision is yours, but if you're telling me this is your forever home, this is your dream home, is that 1 year, 3 year ARM rate for you?
Right.
We have other ARM products, we have fixed products, and even the first-time homebuyer space. We had products that weren't available on our online system for first-time homebuyers just due to the intricacies.
Sure.
And you'd never want one of those first-time homebuyers to slip through into maybe an ARM that isn't appropriate when there might be other products that would be really great for them.
That's awesome. So from your philosophy, digital's great, but a blend is really what you're looking for, depending on your customer base and business model.
Yeah, and I really think it's where we're seeing the studies show us how borrowers want to be approached.
Right.
Going into the digital mortgage space very early, everybody kind of started with online applications, and then we got e-sign and paperless, and now even looking at digital closings. The thought, of course, is a sudden shift away from the counselor loan officer model to borrowers can access it all here, get everything they need to do, show up to a closing, sign some paperwork, bing, bang, boom, they've got a house.
Right.
And I think the studies have really shown, and I think no matter the size of the lender you talk to, they'll have this proven out in their own pipelines. A lot of people want that online advantage. They want to be able to do things digitally. They want to be able to do things at their own time, but knowing there's somebody they can pick up the phone and call, knowing there's a person on the other end of that transaction who can help them through it, who knows a lot more about it than they do, and even if it's just to reassure them through the process that this is okay, that's really valuable and something that most people, when put to it, really want in their experience.
That makes complete sense. Thank you.
Yes, thank you.
So let's talk about second phase of digital mortgages and documentation relief. And we won't talk about the 900-pound gorilla in this arena, the lender that advertises during the Super Bowl, because at the end of the day, that technology and capability is available to every lender, big and small, right? With Fannie Mae's Day One Certainty, asset relief, income relief, even appraisal relief. So are you guys using it right now, and in what facet?
Yeah, so we are. As you know, I've since been a product of a switchover in lenders. My old company got bought out by a new company, and I'm going to be speaking from the old company's perspective. And yes, we did utilize it, and it worked well. The key component of that is obviously really just customer experience. They don't even know what. It's a process where we want them to be able to expedite things, not have to produce all kinds of documentation. And Fannie Mae, wanted us also as a lender to be certain of the documentation that they were giving us back. So from a customer experience, it was really to benefit them, so that they didn't have to go through 1,000 pieces of paperwork, coming up, trying to produce 3-year-old tax returns, 3-year-old W-2s. So the income piece was really the biggest advantage we saw from a lender, because again, it was really seamless to the customer. Again, if you put customers side by side, and someone that was using day one certainty and someone who wasn't, the day one certainty person would not have to provide the documentation that somebody else might have to. Tax returns, pay stubs, and everything like that. The asset situation was a little bit more challenging for us. It took a little bit more buy-in from the customer.
So traditional asset documentation is you're bringing in your 401k statements, your bank statements,
Exactly.
and ultimately, yes, there's account numbers on there,
Right.
and in a vacuum, that is potentially someone else can get access to your information. But the digital mortgage asset experience, talk about that and what maybe some of the reservations of customers are.
So some of the things that we were faced with on that was more or less, a customer would have to provide their sign-ons so that we can gain access to their accounts and therefore get their statements online, so that they didn't have to give them.
So I'm a borrower, instead of me bringing you 30 pages of bank statements, I'm giving you my username and password.
Correct.
And of course, obvious reservations there, right?
Sure.
Of now it's not only you, the loan officer has my information, but it's potentially anyone else on the dark web, right?
Correct, and that was the biggest struggles we had. We didn't push for that all that. I mean, we were kind of getting towards that stage of trying to really introduce that, but we never got there, to be quite honest with you. We were really using the digital world and the technology from like I explained earlier, the income, the employment, and the appraisal that Fannie would give us some relief on that. Again, we introduced it early on in the stage, so that's the biggest challenge too when dealing with these type of technologies and efficiencies, is where can you introduce it, and where's the best place to introduce it into the manufacturing process.
To get some bang for the buck,
To get some bang for the buck. And I know some of the competitors out there, they introduced it a little bit further down the road, which to me wasn't as successful from a customer experience, because again, the true thing that we're trying to get to is, Mr. Customer, we don't want any of your stuff. You tell us where you work, we're going to validate all that.
Right.
You don't have to provide me anything.
Right.
If you start doing that at the time of, say, underwriting, that stuff has already been gathered. Sure. And it defeats the purpose. Now, granted, you still will get some reps and warrants from the secondary market investors if you do still provide that information and perform those tasks. But to me, that wasn't the most success that we would have with the program.
Sure.
So, the asset piece, like I said, I wish we got there. My challenge is, going on to this new bank, is to try to introduce this. They haven't utilized the services at all. I really do believe there's a huge benefit in doing that.
Sure.
Fortunately enough, the market and the business itself and the industry hasn't taken off with this, other than that the gorilla in the room that you talked about earlier. Not a lot of people are utilizing it, so we're not behind the 8 ball at this point in time, but I don't want to get there.
Sure.
I want to be, it's always best to be the first in market to introduce something, and to use those services, I think, would just be more beneficial for everybody.
So on the property side, we glossed over a little bit what used to be called the PIW, the property inspection waiver. I think they're just calling it now appraisal waiver.
Correct.
Obviously, that's not something someone's necessarily electing up front, right? You got to wait for the findings to come in. It's going to say whether you're eligible. When that's become eligible, in your current process, are they typically ordering appraisals before you would necessarily know if that option's there, or is it coming afterwards?
No, actually, we were, I always had our loan officers be able to run DU up front.
Do it first, right?
Do it first.
Yeah.
So they will get that finding right up front.
And are they selling that to borrowers? Is it, because as a customer, sometimes I feel like maybe I want an appraisal, right? I'd spend the few $100s.
I will say that we've never had a customer say, no, I don't want to go with the inspection waiver. I want an appraisal. I've never had a customer say that.
Maybe it's just I'm an old guy in the business and I want to see what my property value is, and I want to see all this.
You're paying for the service, but to save $350, $400, they'll take that road every time. Again, it doesn't happen as much as I like it to happen. Fannie Mae has assured us that they've tweaked some things to get it a little bit more aggressive.
In their black box,
in their black box, to have that happen more. But yeah, I mean, when it happens and the loan officer is able to find that information out earlier on in the game, it is a competitive advantage because you can say, hey, listen, some lenders might not utilize that service and or accept that service. So you know, come to us and you might be able to save some money in your closing costs. It certainly simplifies and quickens the process. An appraisal takes, you know, anywhere from 10, 14 days to get back.
Sure.
So you can cut that time out. I mean, that's truly what we're talking about too from a customer experience in this process in the digital world, is taking that time frame from 45 days from app to closing down to 30 days regularly. And so, you know, studies have shown that it cuts off, day one certainty cuts off about 11 days in the process.
That's amazing.
It is. I'm not sure we experienced that much of a hit, but we certainly saw, you know, a definitely decrease in our turn times.
I'd always be, I feel like I'd be paranoid unless I see an appraisal. I mean, we all know Fannie Mae's been collecting this data for, what, 10 years now on property, since the crash. The logic tells me that their data is probably so fine-tuned that their values are probably spot on, but I feel like there's an inherent paranoia that what if it comes undervalued and if I don't have that appraisal in my hand? Right. Have you run into that at all, where properties are coming in lower? Or?
Yeah, I mean, as we've been in the business so long, we know appraising is certainly an art, not a science. And yeah, when you try to crunch all numbers through some algorithm and come up with an end game, that's tough. I mean, fortunately, we don't run into too much issues there. And again, when you're inputting a value, you know, Fannie Mae basically is just saying, taking all that data that you spoke of and saying, yep, we validate that value based off of our documents. So, you know, I will never get a waiver if the value we put in is not supported by that data.
Sure.
So then we go down the traditional way of an appraisal, and then we face any type of situation that we've always faced. But no, it's great. And again, the second piece of all this day one certainty is, again, the reps and warrants we're getting from Fannie Mae, Freddie Mac.
Sure.
And that's incredibly important, so that, you know, as a lender, we're assured, you know, what data we're using, what income we're using to qualify.
No fraud, no buybacks.
No nothing. It's done. I mean, it's you got your stamp of approval. That can come back to you, and that's an important piece.
Absolutely.
On the back end.
So 3 parts: income, you guys love.
Yep.
Assets, kind of hard to get buy-in.
Love it.
Yeah.
Love it.
Sounds awesome.
Buy-in's tough.
Yeah. And the property, it's kind of hit or miss. It's either available or it's not.
Yeah. And Fannie, you know, even if it doesn't give you the waiver per se, you know, now they have, you know, the CU and the scoring of that property, and they give you some reps and warrants if the score of that value comes in a lower.
Sure. So even if you don't have a waiver, you still have some assurance that they're going to come back at you for value. That makes sense. Yep. Awesome. Yeah. Thanks, Rob.
Thanks.
So Sam, let's talk about part 3, electronic digital closings. I know where you're working, you guys are doing them. Tell me a little bit about the process and what that looks like on the lender side.
So we are the first lender in Connecticut doing digital closings. It's been an interesting process working with all the settlement agents, our loan officers, getting everyone to kind of buy into this new process that, you know, is very big departure. You know, everyone's used to going in and signing, you know, 45 pages of documents and going through this, and now, you know, spending 3 hours at the settlement agent, and now with a digital closing, they get the documents a day ahead of time, they're reviewing things, and they're going to the settlement agent and closing in 20, 25 minutes. And so things are a lot quicker on the settlement side. So it's been interesting to see the dynamic of how people are accepting this change. It's been a challenge at times. Some of the settlement agents are worried about being pushed out of the process, which we kind of assured them that they're always going to be here. This is not going to be a problem. They're not going away. We still need lawyers to close these loans. So it's been an interesting process.
What about the work on your end, though? Obviously, you don't just sign up with a partner and the next day be able to effect an e-closing. What was involved on the IT end to get this up and running? I assume it's not plug and play. You've got some work to do, right?
No, so it's been a fair amount of work on the IT department. We had to map all of our closing documents, make sure that the signing points are in the right spot, handling multiple borrowers, non-occupant co-borrowers that are on the deal, things like that. So we've worked with our vendor, provide them copies of all of our documentation. We've done our mappings. We've done a number of test runs to make sure that everything maps the way it should. There have been discussions on process. You know, they're pretty open-ended on allowing us to make changes to the process. So We wanted to keep it very similar, so we actually ended up with the same process our closers are going through now when they send documents. But instead of
So same doc providers, same LOS.
same doc provider, same LOS.
Goes to a portal.
Yeah, it goes to a portal. So now instead of the closing, the closer is sending documents to the borrower, and the settlement agent, they're sending them into this portal through our provider, and the provider is then sending them out to the respective parties, whether it's the closing agent or the borrower, so that they can review them ahead of time.
That makes sense. Now, when you talk about mapping docs, right?
Mm-hmm.
Every state's got state specific. Every program's got program
Yes.
specific. Are you talking about multiple? So if you've got 5 products, which of course I'm sure you have more, you've got 5 products for Connecticut, 5 for Massachusetts. That sounds like a lot of mapping.
There is, anything that's a general like Fannie Freddie, those documents are the same across multiple states.
So it's not necessarily by investor.
So it's not by investor per se. It's mainly, it's by state because a lot of states have different requirements. So by investor, it can be pretty similar. You're going to have the same note and deed, for different products in the same state, but as you go across to different states, those are the things that are going to change.
Sure.
And a lot of investors have some specific documents that need to be signed. Generally, it's more of the private investors than Fannie Freddie. There's
Sure.
no specific document for Fannie or Freddie, but some of these bank investors have specific documents that need to be signed. So that brings a little complication into it, knowing which investor is going to be getting this loan when we're closing it.
Sure. So how do you account for that? So you've got, I believe, how many states are you doing business in right now?
I believe we're doing in about 38.
And let's assume you've got conventional, like Fannie, Freddie, FHA, USDA. So you 38 states, let's call it 5 products. Did you just roll out nationwide and hit and say go, or did you just kind of scale it?
No, we did a staged rollout. We started rolling out with Connecticut first, and then we expanded it once we did that. So it gave us a good base to start from. We have a good base of settlement attorneys in Connecticut, so we knew that there were some that we could work with on this process and as a pilot process, so that before we rolled out across the country, we had the process down pat. And we're able to troubleshoot any issues that came up versus rolling it out across the country and dealing with triage, on a large scale basis.
Now, Connecticut, to me, intuitively doesn't seem like the best place to start because, for good or bad, we got a lot of smaller closing agents, law offices, mom and pop type shops. You mentioned buy-in. What are some of the challenges on buy-in, both on your lender side with loan officers and the sales force having to understand why this helps their customer, having customers understand why it helps them, and then of course on the attorney side, like what are the struggles on all 3 facets, lender, customer, and the closing agent?
So on the lender side, it's getting the word out there to the LOs and getting them to explain to their borrowers how this will make the process better, the time saving, the ease of the process, that sort of stuff. With the settlement agents, it was a little more difficult. As I said, they're kind of worried about being pushed out, and you can do this on any computer system, but if you have a touch screen, it makes it a little bit more of a slick process. So some of them wanted to purchase new equipment.
Did you need touchscreen?
You don't need a touchscreen, but as I said, it makes it a little slicker of a experience. You can do it on any computer, but
even a desktop?
Desktop, laptop, tablet, anything.
So you're either touching a screen or you're clicking a mouse, basically.
Correct, and so that required some finagling on the settlement agents. They needed to have a computer that was separate from necessarily the one they're using on a day-to-day basis because they don't necessarily want borrowers using their computer.
Sure, at their desk.
Exactly. So there was that. And there's also some costs associated with it for the settlement agents. So, we were able to offer some relief to some of our settlement agents that do business with us to get some buy-in. And with the customers, it's a new process for the customers. So, they hear e-closing. I'm sure they've heard about it. Depending on the age of the person. But just hearing about it doesn't really. They don't have an idea that yes, there are still some documents you have to wet sign.
Well, let's talk about that. So, when you're saying it's electronic closings, yet there's some documents that have to be delivered and signed wet. What are those documents?
So things like the note and the mortgage, those have to be wet signed in current world.
That because of investor requirements or agencies?
It's some recording issues, things like that. Their e-notarization is becoming a larger thing nowadays, but you're at the mercy of some of these small counties and towns where the guy that's doing recording is also the guy that owns a hardware store, and he's in 2 days a week.
And I think
like
notarial law, I think, is written by, I think that's a Secretary of State oversight, right? And of course, there's 50 of those.
Yes.
So by nature, yeah, I can see how that'd be cumbersome.
Yeah. So it's an ever evolving process. As this becomes more prevalent, it's going to become an easier process, but like I said, at this point, there's still some wet signed documents, and you also run into the issue of, something that needs to be signed, comes up last minute, needs to be signed, so that may not necessarily be able to be signed electronically at closing, so that has to be wet signed.
Now, how does the platform make that work? So you mentioned that the closers are delivering it to a portal. From there, it goes to the bar, to the attorneys, but you've got some docs like the note and mortgage that have to be wet signed. How does that
So the system recognizes those documents. It's been trained on all the documents that can be e-signed and ones that can't be. And so it automatically knows that these documents can be e-signed and applies those signing points on documents that it knows have to be wet signed. It separates those out, and then as part of the process, once the e-signing is done, before the settlement attorney can actually finish the process and complete it, they have to print out these documents and have them wet signed.
Cool.
So once that's done, it allows the attorney, it knows that they've done that, it allows the attorney to complete the process, and then it e-vaults all of this stuff so that the borrower has long-term access to these documents forever through a web-based portal.
So unlike me, I've got a fireproof vault with every closing I've ever done. They can just log in and view their docs online.
Correct.
They'll probably print them anyway, but at least they have them available. That's pretty cool.
Absolutely.
Now talk about post-closing. When the docs are electronically signed, how do we know and how do they come back to us? And is there risk of something not being signed?
Yeah, so there's a notification to the lender, back to us, that says that these documents have been signed. There's no way for any electronically signed document to not get signed. However, a wet signed document could, in theory, not get signed.
Sure.
But once they come back, our post-closing department gets those documents almost immediately, and they're able to immediately review and see if there's any issues on wet signed documents, and if there's any data integrity issues on any other documents, that can happen at times. So they can immediately do a scrub on those and get things re-signed if they need to pretty quickly. Back before when we were waiting for a FedEx package, you're talking a few days, maybe a week.
Right.
They get it back and then they review it, and then chasing down a borrower to get stuff signed can not always be the easiest thing. So now they can see it pretty quickly, almost immediately thereafter, and know if we need to get something signed so it can be scheduled with the borrower to come back and get things re-signed.
Yeah, so intuitively, if you take the number of closings in a day and the number of docs in a package, the chance in a standard closing of having something come back unsigned or maybe an initial miss is pretty high, right?
Absolutely.
It sounds like, though, what you're describing is they can't complete their transaction unless everything is done correctly.
Correct. So it eliminates the burden on post-closing of chasing down documents that aren't signed or incorrectly signed or incorrectly dated or not
even
dated,
scanning docs,
or even
right?
something scanned back wrong, pages stuck together, things like that.
Sure.
Those are all eliminated with the electronic closing, and all we just really have to worry about is the wet signatures on the note and the mortgage and things like that. So the few documents that need to get wet signed are the ones that are coming back, and those are the ones that get scrubbed.
Now, what about, you've got new technology, you've got additional processes. Sure, it's easier for the bars and closing agents on the day of closing. Mm-hmm. I think I heard you say 15, 20 minutes per transaction. How much additional work is on the closing staff to kind of perform these additional tasks just to generate the closing package?
For us, it's not really any additional. As I said, the closers are following the same exact procedure they were doing before, but instead of sending it to the settlement agent, they're sending it to our provider. So it doesn't add any real time onto their days, and when they have to do an update for a document, if something changes before the closing, they generate that individual document, they submit it to the same portal. the portal on that far side automatically replaces that document with the updated version, so we don't have to rely on a settlement agent possibly swapping the wrong document or not using the most current version. So
That sounds awesome. You have the best of both worlds. You're
Absolutely.
creating value and a service to the customers with no additional work on the staff. In fact, less work when
Less
you factor
work,
in
yeah.
post-closing, and potentially more than likely a higher quality file received.
Definitely.
That's awesome.
Yeah,
Thank you, Sam. As I promised, that was a really long video, but there's a lot of really good content. I actually learned a lot just from listening to some of the answers. I hope you learned a lot as well. I promise they won't all be that long, but it was a really good topic. Thanks again.